Hello and welcome to another episode of LOTEK Wealth. I'm Brad Burns, and this time we'll be discussing financial gerontocracy and the control of these global financial markets using some of the most mismatched and illogical tools known to mankind in the biggest hunt you've never known that you were already a part of. Today we're going to be talking about the everything short. It's a creation of due diligence from the mini-wrinkled brain at Tobit, March 31st, 2021, published, translated by yours truly, the single-wrinkled brain, DRS GME Brad. First, allow me a disclaimer. I am not a financial advisor. I am an ICU nurse trained 6 years, and all I've learned really is how to critically think and get to the root of explaining things in simple terms, because there's a lot of obfuscation in medicine and also in finance. Objective bullet points. Treasury Department is directly or indirectly involved in allowing or ignoring mortgage-backed securities and corporate bonds to be shorted using the repo market. Citadel owns Palafox trading exclusively used for shorting. Palafox manages one fund for Citadel, Citadel Global Fixed Income Master Fund Ltd. $123+ billion of assets under management are 80% owned by Cayman Island investors offshore. This RRP, or reverse repurchase agreement, is 100% rehypothecated and cannot be paid until someone pays them. Subjective: buy, hold, DRS, hedges are fucked. There ain't no water in the well. A quick side note, this is the definition of a Ponzi scheme. A Ponzi scheme based off of Charles Ponzi, better known as Charles Ponzi, born Carlo Pietro Giovanni Guglielmo Tabella Ponzi. Sorry, Charlie. Now, Charlie wasn't the first to do this, but what he did is take discounted postal reply coupons from other countries to redeem in the United States for a form of foreign currency arbitrage, promising new investors 50% return in 45 days and then 100% return in 90 days. He made about $20 million, $200 by today's standards, in about a year from 1919 to 1920. And this has been done countless times before him, but poor Charlie got the name. He's associated as the Ponzi scheme guy now. Alas, back to Kenny and Franny's. The Everything Short is a follow-up on Citadel Has No Clothes, which left a Tobit with a burning question: why so many derivatives and so few physical shares? Even Melvin kept their derivative exposure to 20%, so seeing 80% of this Palafox portfolio is derivatives? The quadrillion-dollar time bomb becomes more and more obvious. A Tobit is kind enough to divide this complexity into 4 repurchase and reverse repurchase agreements: treasury bonds, Palafox trading, and the short seller endgame. Repurchase agreement, or a repo, is a loan. You go to the pawn shop, you got $1 million banana, they give you $1 million, you'll come back to buy that banana back for $1 million. A reverse repurchase is the loan from the pawn shop's perspective. Now, these are the lifeblood of global financial liquidity. Super fast securities to cash. Now, this overnight reverse repurchase agreement is happening daily to the tune of $2 trillion between commercial banks, broken banks is what our bank is, and hedge funds. Now, the Lehman Brothers, or Lehman Brothers is the name of their company. You can call the Lehman Brothers, whatever. I like to get family oriented, as these are family funds that somehow don't report the same way as large investment funds. Anyways, side note, Lehman Brothers bankrupted their $600 billion because of fraudulently marking repos as sales and using mortgage-backed securities as collaterals or assets instead of the debt they actually represent. Check The Big Short, in which multiple parties participate in fraudulently marking mortgage-backed securities higher ratings than the mortgages actually were. There was very little amortization, high adjustable rates, and for a hot minute, no job, no income verification for mortgages. Remember how that goes? Just get these poor strawberry farmers some homes. It sounds great when you just want to give them a home and not really worry about if they're going to be able to pay for it. It sounds great. But the dark and stormy story that is behind every single one of these mortgages is 20+ times the value of that home, which is a debt to the individual, to the strawberry farmer, is used to pump up these financial markets and these instruments that they use us like puppeteers with their debt as if it's a liability to us, but somehow an asset to them. What? bond market is the red-headed the red-headed, strep-infected stepbrother of stock market, according to Tobit. Now, bonds are the other half of currency. A government sells a bond for $1,000 with percentage returns based on how long you hold it. 3, 6, 9 months, 1, 10, 20, 30 years. Main point is, in conjunction of buying these bonds along with mortgage-backed securities, is the Fed is not only the lender of last resort to risky bets, if lost, is not only the lender of last resort to risky bets if lost, destroy the monetary system so many rely upon. Runs on the ATM, no loans offered, no capital for any upstarts, bartering, and hard assets returned to communities. But also, more importantly, this wombo combo allows for infinite liquidity as long as the money printer stays powered. Inflation was never transitory. It was guaranteed. Palafox Trading, the fox in the hen house. It's an unheard of market maker for repo agreements. LLC, out of Delaware, member of FINRA, clearing member of FIC. So the repo market provides immediate liquidity to hedge funds and other financial institutions. After the mortgage-backed security collapse in 2008, the U.S. Treasury replaced mortgage-backed securities with RRP as the liquid asset of choice. Citadel owns 100% of Palafox Trading, which is a market maker for repo agreements. This market maker provides liquidity to the Global Fixed Income Master Fund, LTD, goes by GFIL, through Citadel investors. 80% of its $123,218,147,399 in assets under management belong to entities in the Cayman Islands. Mortgage-backed securities were preferred prior to 2008. Got it. Now their lack of attractiveness equals not enough liquidity. So March 2020, coincidentally, beginning of COVID, and the printing of 80% of all the money in existence, what we'll call the COVID flash crash, brought the reverse repo rate to 0%. Free money, free liquidity, free loans. Get it. As the Fed has been raising rates to combat inflation, this has also been applied to the reverse repurchase agreement rate. There's a rebate, which means there's a reward for a reverse repurchase agreement on top of it already being free money, overnight loan. Must be nice. With the Fed printing free money and the repo market lending free money, there's zero difference between cash and collateral, as supply and demand dictates more supply equals less demand, so 10-year bonds decline. They meet failure at negative 3%. This has happened multiple times. March 4th, 2021, there was a negative 4.25%, which means there were banks paying to lend in exchange for 10-year bonds. Major desperation and a huge bond squeeze is indicated by that. At the end of 2020, it happened as well. Palafox had a gross $31,257,102,000 worth of repos, of which $30,576,918,000 are directly related to repurchasing bonds. Substantially all securities are used as collateral, repledged in connection with repos. This means nobody has anything. In 2019, Palafox had $7,739,032,000 bought to resell, compared to their $7.78 billion sold to buy back. Again, it looks like they've bought more to resell, or no, they've sold more to buy back than they've bought to resell. This is a huge shell game of just a back and forth of frothy monkey money that means very little when it comes to hard assets in the market. And it's only been increasing. In 2018 compared to 2019 is $5 billion bought to resell compared to about $5 billion sold to buy back. Remember rehypothecation. It's a Ponzi scheme. Using amounts owed to you as collateral, securities waiting to receive already pledged to pay off bonds currently owed to someone else. Pledged. Thanks, Amber Heard. Wrapping up, let's talk about FIC. FIC, Fixed Income Clearing Corporation, branch of DTCC that deals with government securities. FIC has $47 billion in deposits from unsettled bonds. $47 billion, basically in failures to receive. That's a lot of liability for the U.S. financial system's liquidity to rely. I really hope the faith and credit of these institutions provides guidance as to how to hedge against this impending major market crash. Oh wait, only guidance is sell now, ask questions later. It makes sense when you think about it, really. When the global market is full of vile schemers, the last thing you'd want is investors demanding failures to no longer be strategic by recalling their securities into the transfer agents of each company. Next low-tech wealth video will be about what inflationary policies and economic negligence led to the roaring 20s, where Ponzi made his millions off of endless market confidence, and what led to Germany and the Weimar Republic into hyperinflationary crisis. That's right, going back to World War I. Like, follow, share if you care, throw me $1. I'll see you guys on the flip side. Love ya. Thanks.